All right, well, welcome everybody. I'm excited to share this new investment opportunity. The title or the name of the apartment complex is called The Gallery. I've spent 19 months working this deal. I found it through an off-market search where we found the recorded owners from the Harris County Appraisal District, went to the Secretary of State website with Texas and found the true owner, skip trace the name and the phone numbers and emails. And what has really come over the 19 months is a really good friendship with this doctor who owned this property since 2007, based out of Los Angeles. He's a cardiologist and really a fantastic man and person. And, we've had a really good relationship, and, it's been his baby. I mean, we were on site earlier today, and just the property manager and I we're talking, and just how much this property has meant to him over the years. Now, it's been a cash flowing property, and as we'll talk about later in this presentation, he hasn't done really any renovations since he purchased it, which is an incredible value add opportunity for us. And I'll share a little later on what we're planning on doing. But I want to just tee up on the, sort of the background to get where we are today, because it is harder and harder to find true, solid, value add multifamily opportunities that are being done off market. I mean, just give you an example, most apartment contracts are done with a 40, 50 page legal contract. We use the good old TREC form as if you're buying a house, like 15 pages, if that. And so very, very excited about this opportunity and the relationship, and just the proof that, patience and relationships really matter in this business. So super excited to share more on this opportunity today. I do want to start out with a disclaimer, though, that this truly is my viewpoints. It's the company's viewpoints on our research and our experience. But ultimately, everybody on this call and those listening to the recording in the future has to make their decision based on their experience and knowledge. And so this is not a presentation to offer securities. This has not been reviewed or approved by the Security Exchange Commission. This is simply sharing an opportunity. And then once we have our private placement memorandum, which I'll share those timelines later in the presentation, that's where the offer of the opportunity to invest with us into this opportunity. But just really want to start off with a disclaimer: one, because attorneys tell me to do it, but two, just so this is an opinion of us as a company. And I just ask that everybody do their own due diligence, and I'm happy to answer any questions, et cetera, after the call and go into more detail. So I always like to start off with 3 reasons why I'm just super excited about the deal. One, I already teed us up earlier, but it's an off-market direct to seller. We didn't have to do a bidding war. This is not best and final offer. This is a relationship that has been in the works for the last 19 months, to a point where the seller called me up about, a month ago, a few weeks ago, and said, "Hey, I'm ready to sell and start the next chapter in my life." And so it's just an incredible opportunity. Just for that reason, I'm finding more and more multifamily investors are becoming more sophisticated. So the idea of buying a multifamily mom and pop, it's harder and harder, especially at this size. So huge exceptional reason, number 1. The second exceptional reason, number 2, is this truly is a diamond in the rough, lost in time deal. We'll talk about the location from a macro, from Houston to Galleria to this property. But since 2007, there has not been any major renovation. HVACs are original, the roof's original. They did do some painting a couple of years ago on the siding. And, I think they've done, I feel like every time I go back to the property, there's more upgrades, renovations, like to the landscaping. And I joked with the property manager, I'm like, y'all are just making it easier for us when we buy it, because they're making it look better and better. But it truly is a lost in time deal. Huge upside on the revenue. We'll go through those not only from a base rent standpoint, but also miscellaneous income. and then we'll go into operating expenses. So we'll share all of our financials shortly. The other thing too is its location. Real estate is location, no matter what the economy and the cycles do, because nobody has the crystal ball. But in real estate, mitigating risks when it comes to location is key. This is in the Galleria submarket. We're going to dive into what and where the Galleria submarket is shortly. But I will tell you, knowing these markets extremely well, finding a Galleria submarket property is it's an incredible location. The amount of people that are working and living in this submarket, the median income, et cetera, et cetera, et cetera, makes this an incredible reason number 3 to consider this investment. I'm putting this slide here. This is not your ordinary multifamily deal. Now, there are ordinary multifamily deals, and that's good. We like cash flowing type deals. This is a true deep value add. And for those on this call and those listening that know me, know that it's not about the number of deals we do. It's about number of good deals we do. And, I will tell you that one, the relationship with the seller, but 2, just the lost in time aspect of it in pretty much every aspect of the property operations, revenue, et cetera. It just does not make this an ordinary multifamily deal. So it's super exciting. And we'll dive in a little deeper. So I have one slide here just for those that are newer to multifamily investing and looking at the participant list, a lot of people that I have spoken with previously. But ultimately, I invest in multifamily because I have a lot of experience in commercial real estate, a lot of experience in office, a lot of experience in retail and industrial. And at the end of the day, where I like to put our money, family money, and personal money is in multifamily, because in my experience and just the fact of life, everybody needs a place to live. And so it doesn't really matter what's going on in the markets, things will ebb and flow. At the end of the day, people need the hierarchy of shelter, right? And this property meets the requirements. It's not a sexy trophy Class A building, nor will it ever be that. But ultimately, even was saying today to some of my partners, like, I could live here. And that's hard to say in some properties that we look at, like, it's not about me. It's about, the people in the community, et cetera. But this is a property in the neighborhood that, we could truly, feel comfortable living in. And so risk resilience is key, number 1. 2, I mentioned my experience in office and retail and other commercial asset classes. Multifamily year over year outperforms those. Inflation, everything that we're hearing about in the news, it all bodes well for multifamily. And when things are tough, when COVID, pandemics, hopefully that's not going to happen, again, or, anytime in the future, near future, but it didn't impact multifamily. If anything, it put a lot of money from institutional and other buyers into this asset class, making this more desirable and more profitable for the investors. We like multifamily because cash flow and equity appreciation. We'll go into the financials later in this presentation, but I want to sort of step aside from the cash flow and really go into the equity appreciation, the true forced equity. The data shows us that the location and everything going on in the submarket in Houston, in Texas, in general is going extremely well. But when you're able to force appreciate, that's where I get super excited about and can talk about, this opportunity and others, all day long. Because at the end of the day, forced appreciation is what's going to make every one of us on this call a lot of money. And the last is tax benefits. Right now, we're going through a cost segregation process where they're looking through what our capital plan is going to be, and then looking to see what our expected tax cost segregation. Now, this is personal. Everybody's going to have a different tax situation. This is passive income for everybody on this call. And so the tax benefits, if you're not a active professional, real estate professional, offsets passive income only. But at the end of the day, we look around and we see the people that are, have done really well in real estate, but not paying all the taxes. And it's just because it's a legal way of doing of depreciation. simple depreciation and what multifamily can do with accelerated depreciation. And so it's a huge benefit for all. So these are the main reasons why I and CREI Partners invest, and why I'm such a big advocate and try to educate as much as I can with anybody that listens on why people should go away from the herd of doing other traditional investments and look at multifamily. Now, a little brief background on myself and then the partners that are on the deal. So my name is Wayne Courreges. I've been in commercial real estate for the past 14 years. It'll be 15 years in June. Prior to being in the commercial real estate industry, I served in the Marine Corps for 4 years, 2003 to 2007, went to 29 Palms, served with 1st Tank Battalion, and then was in Okinawa, Japan with the Air Wing. My first property was in the Marine Corps. I think I was 20 in 29 Palms. It was a 1-bed, 1-bath. So early on in my career, in my life, real estate has been a passion of mine. I have a CPM, Certified Property Manager designation from IREM, an MBA from the University of North Carolina, Ken Flagler Business School. I host a meetup monthly, the fourth Monday of every month. It has over 800 members and continues to grow. And this meetup is all about educating prospective passive investors. It's not about selling our deals or trying to get people to invest with us. Our goal is to educate people so they can make good decisions and ask the right questions when they're looking. So I hope, please join us if you're interested in doing that virtual meetup. I have a podcast, The Untold Stories of Real Estate Investing. We go through single family and industrial and multifamily and really try to hear the raw truths of all the work that goes on when owning and being an active investor, but also going into what it's like being a passive investor and the benefits and maybe the cons of it as well. And finish it up here, I've got a Facebook group that I'd love for everybody to join, Texas Multifamily Passive and Active Investors Group. I mentioned I'm a former U.S. Marine. I'm an Eagle Scout and an Austin member of the Rotary Club. So a little bit about myself, and I'm super excited to introduce our partners here. We are in a mastermind together and really have seen eye to eye a lot of similar values, and it's like a marriage. We have to find the right team. And I found it with Rob, Jeffrey, and Jennifer here. Rob is the founder of Harbor Drive Holdings. They're based out of San Diego. They're a general partner manager in 300 plus doors across 5 syndications. Their assets under management exceeds $200 million. They have a ton of experience in asset management, day-to-day operations, acquiring properties. Super excited. Rob was in Houston today, so I got to see him. Jeffrey Potter is a wealth of knowledge, has a lot of experience and relationships, and has really elevated our team. Has orchestrated over $4 million square feet of commercial real estate transactions over his 30-year career. He's a guest lecturer and graduate of University of Southern California and is a California broker. Again, similar to Rob, brings a lot of experience, a lot of passion for this deal and others that we're planning to do in the future. And then Jennifer Falloon, she's based out of San Antonio, Vorsa Investments. She also met with her on the property today. Just a fantastic person, somebody who has a lot of excitement and passion and grit for real estate investments. Their team manages and has acquired over 100 million in apartment complexes with their partnerships. And so I'm super excited to have Jennifer part of the team as well. I will tell you, her and her son Cameron, when we walk in these apartments today, they were already adding so much value with their experience and things that we could be doing. And I just told them, it's like, hey, this is a team sport. Everybody here brings their own lens of their experiences and all. So it only is going to better everybody. So super excited to have her, Jeffrey and Rob on the team for the general partnership. So how I want to go through this presentation is I'm going to go from a macro into the property. So I want to speak to the overall Houston market and why I've been bullish about the Houston market for several years. I lived in Cypress for 5 years, 2012 to 2017, where I managed Marathon Oil Tower, which was in the Galleria, and managed Fulbright Tower, a high-rise downtown. And so I've always loved Houston. It's a special place in my heart, but at the end of the day, it's all about numbers too and metrics. And then we're going to go into the Galleria submarket, then we're going into the property, and then we're going to go into the financials. So that sort of tees us up to this remaining presentation. So Houston is among the 25th largest US metros. It ranks first for projected total population increase from 2021 to 2025. Just looking at these graphs here, projected population growth from 2021 to 2026 is about 11.6%. The annual rent change year over year has been about 7.3%. Projected population growth has been 7.1%. The unemployment has been hovering around 6.6% as of May 2021. And the effective rent gain year over year is about 5%. So this is according to the Texas Workforce Commission and other resources down below the slide. Now, mind you, that is the overall Houston market. The other thing that when I love talking to people about Houston is it's more than an oil city, you know, and it was that way when I lived there with the amount of universities and the medical center and the Port of Houston, the sports, the entertainment, the food. I mean, it's just an incredible city. The diversity, which is what I'll start off with here, #1 most diverse cities in the US. I mean, it was incredible. All the diversity, all the foods and, you know, just going out and just meeting people no matter where they were and feeling, you know, like everybody's at home. So they were #1 most diverse city in US according to Wallet Hub in 2019. They were the #2 metro with most corporate headquarters, according to Business Facilities Magazine 2019. #2 top metros for job growth, according to the US Bureau of Labor Statistics in 2019. There's over 3 million workers in the Houston metro, just massive, massive city. And if you've driven through Houston, it's almost one of those cities that never ends. It just continues going. And then different pockets of Houston develop into these little cities like the Galleria, the Woodlands, and other areas. The #5 cities of the future in North America, according to FDI Intelligence. Cities to go and eat, Food and Wine 2019, and the best cities for millennials, the Langston Company in 2019. And going on further, it is truly a massive global city. $120.7 billion of US exporting, according to the International Trade Administration. There's 33.3 million passengers that are handled through the airport system. 220 trading partner countries, 90 international consulates, as the #1 best seaport in North America, according to the Asia Cargo News. #1 best hospitals in America, US News and World Report. And that's one thing I like living where I live, is just having access to the massive medical center that's there. And then 14 major institutions of higher learning. So it's just a great city with a lot of potential, continued potential, and not, you know, it is an oil city at the end of the day too, but there's a lot of diversity of all the different companies that are there. So according to Axiometrics, rents forecasting within the 23 submarkets is set over 5% in 2022, 13 submarkets in 2023. The Houston market in general for multifamily has just continued pushing, as you can see on the bottom left here, average occupancy compared to average effective rents. You know, the average occupancy is continuing to go up along with effective rents. The post-pandemic rental rate rebound is, as you see, quite massive. And as we go into the financials, I don't have a crystal ball of like, this is how it's going to be forever. And so we've made some risk mitigators into our financials. But you can see here, it's been really positive. And I think part of that is just we're in a very business-friendly state of Texas, and a lot of people are moving to the state. And so you have all these different drivers that just continues pushing, you know, our supply and demand in a way that benefits multifamily. One thing I want to point out here is the second half of the year with demand is pushing 22.3% in rent growth. On the T6, we're looking about at 14.6. 2023 projections are about 4.3% on rent growth. Average occupancy has reached a 2-year high of 90.7%. It's up 220 basis points from the start of the year. And so the whole point of these few slides on Houston is it's a solid market. It's a market that I personally, like I said, love to invest in, and very bullish on. Now, going to the Galleria submarket. So if you've been to Houston, you've got your core downtown market, and then you have the Galleria. The Galleria is, I would say, like the second downtown of Houston. We'll go into, I think it's about 6 miles away from downtown. if you look, this high skyscraper, the brown one there, it's Marathon Oil Tower. That's property I managed back in 2015 through 2017. But so know the gallery extremely well. It's in a sought after walkable area. Easy access to the 610, I-10, 59, West Park Tollway, 30 minutes from George Bush International, 20 minutes to Hobby Airport, 15 minutes downtown Houston. It's in a great location surrounded by a lot of skyscrapers, a lot of business, and a lot of people living. There's a lot of net worth there as well. When you get Tanglewood and off San Felipe, et cetera. So this area, especially where the gallery is located, is continuing to renovate and reposition itself to continue growth. On this slide here, occupancy rates are about 94%. T3 actual rent growth 22.3%, and that number is important for later on in a slide. Unemployment rate 6.9%. Median income is $62,644 for the Galleria, and projected rent growth at 4.3%. So with all the number of towers, both from office and residential, the Galleria Mall, if y'all have been there or want to Google Galleria Mall Houston, it is massive and it's very Class A, incredible stores that have very high-end stores, retail in there. There's also, this property sits between Richmond and Westheimer. And on Richmond Avenue, there's this massive public art project going on. It's called the St. George Place Redevelopment Plan. So we're seeing a lot of revitalization into a nearby sector of the Galleria, which I think bodes really well, for us at the Galleria Apartments and other properties nearby. So I haven't done this in previous presentations, but I want to try to use a little Google Earth here. And I don't know if y'all see my mouse, but if you, to the left is north. So if you're looking down where the red arrow is north. So where the gallery is West Houston, and you have Houston has three loops. Okay. So the first is 610. So 610 is the inner loop. So gallery is right outside that loop. Then you have the next beltway, and then the outer is 99. So from a standpoint of location, I mean, you're pretty much in the bullseye of Houston Central. And we're going to zoom in a little further here. See how close to the arteries of all the different highways systems. A lot of housing in the nearby area. Across from us, we have an office building. But I want to pause here because if you look at the roofs, like they needed work, and the HVACs are original. You see the rusted carport. I went into one room and it smelled horrible. And I'm like, man, the smellier they are and the uglier they are, the better they are. So I just started to get excited. I mean, at the end of the day, like there's just so much opportunity here. And yes, this is not, roofs, may not pencil in day one rental value, but what it does is it allows us to set up a story. So when we sell, we can say the roofs have been done, the HVACs have been done, certain systems are in place, have been done that haven't, to make it a better property for the next buyer who's willing to pay more. So that's one. And two, as we raise rents and we make this really a new community for our tenants, residents, they're not having to worry about leaky roofs when we've raised the rents, quite a bit, right? So at the end of the day, we want to be a good owner and take care of our residents. And in doing so, we're just going to have to, put in the money on the outside as well as the inside to reposition this asset. So, but all in all, pretty solid, 3 acres of property. Try to get to the next slide here. So one thing, everybody, I'm just going to get it out there. Floods, hurricanes, Houston has had issues, right? And I was there during Hurricane Harvey. One thing that I love about this property, it is not in a flood zone and it has not been flooded during all those major storms. And when I was there, I mean, we had the Tax Day flood, the Memorial Day flood, we had Hurricane Harvey. Before I came, there was Ike. And so having an owner that's owned this property since 2007, we've got a lot of prior history uh, with him, and also relationships with the insurance carrier, et cetera. And, I want to put that out there, just from a standpoint of, hey, if we were along one of these bayous or in a flood zone, we would be walking. And we've turned many, many properties. That's the first thing I look at in Houston is I go to the FEMA flood map and check where the property is located. But this is a huge peace of mind uh, when investing and buying the Gallery apartments. So let's talk a little bit about the community. So um, this property I mentioned was owned by a doctor. There was some renovations done in 2006. He bought it in 2007. It's been a cash flowing property for him. And, he really hasn't wanted or needed to do much. I mean, his focus has been on occupancy, not staying up with market rents, which is that lost in time thought process. But significant capital improvements, both on the interior and exterior, but also day one rental income is achievable, even without even doing. I gave the property manager a high five today when I found out she was, she's raised her rents $75 from last week. I'm like, great, we can do more, and we can do more because we know the market. We've gone to these other properties and realized, like, hey, we're charging $20 a parking space. Where do you get $20 a parking space anywhere in Galleria? Like, I've walked these properties. Everything's over $35 or more on parking spaces. So day one, we can do operational changes on parking without having to do anything to the property. If they want to be in this location, it's market. The other thing too is there hasn't been a lot of reimbursed utilities on water, but all the other properties around get full reimbursement on water, electricity, gas, their pro rata share. So, that's something day one we could start implementing without doing much of these renovations. We're going to talk about I'll share shortly the capital plans for the pool and, the playground, et cetera. But as we reposition and we make this property go up to market, like, I'm not trying to lead the market. I'm not trying to say, hey, let's get the Gallery, like, be the front leader. Like, hey, that'd be great. But even if we just get to market, our investors are going to hit their returns, and we're just going to continue exceeding it, as we find more opportunities to increase revenue and decrease expenses. So Tarantino is our management company. They're based in the Galleria. They have about 15,000 units in Texas. I've met with them, yesterday. We had calls today, or we met with them on site today, had calls with them yesterday, had calls with them last week. They are fully in line and are on board with, our projections. And I will say our projections are conservative. At the end of the day, I'd rather under promise and over deliver. And so, we feel like we're going to knock this out of the park. But at the end of the day, the people that are doing day-to-day management and managing the construction process have to be the best of the best. And customer relations, tenant relations, the financial reporting, the oversight, supervision, all these things, safety. And I feel very confident that Tarantino will do that. And I've got a slide a little bit more about them. So I mentioned this is a 101 unit community. It's a mix of 1 and 2 bedrooms. The average rents are $817 to $917 in monthly rent. There are 6 buildings. 5 are the apartments where people live. 1 is like a community where there's a fitness center, which, by the way, has been closed because all the equipment is in disrepair. And, easy as just cleaning it up and changing out some of the equipment gets us back our amenity. But, with the 6 buildings and the reduction in effective rental compared to the market, it's super exciting. This is a gate covered parking community. There are laundry facilities. 4 of the 6 units are operational, so 2 are not. So we're looking at potentially canceling that contract that's with the laundry provider that rents us the equipment, and put in our own laundry equipment. And all that cash flow 100% goes towards our investors' bottom line, not split between another company. Covered parking, the fitness center and pool are great amenities. So the bones are good. This picture here to the left, the top left, is a unit that is opened up to the management office. And I'll try to explain this, but when the owner comes in, he stays in this apartment. So walking day one into this management office, the value add, just walking into this management office, is we have a unit that's not collecting revenue. And so it's simple as boarding, walling that up, making it soundproof, and having this unit as a rental revenue producing unit. But the unit looks nice. Not all the units look this nice, but the owner has lived there. The middle picture to the top middle is the management office. So very nice management office. You'll see, a typical restroom. One thing we noticed in our due diligence last week is we were planning on doing 81 units of the 101, doing some sort of renovation. But we found last week, it was most of them already had black appliances. So with the supply chain issues that's going on in the appliance world and everywhere, that's a huge, but also, we budgeted 7,500 an apartment. And today we were talking will probably be about 5,000 a unit. We're going to keep that contingency in case of, prices continue going up. But the other thing I want to mention on this slide is if you look at the bottom right corner, these are all private patios. All of these apartments have private patios. Now in our underwriting, we didn't separate like ground level and second level from, which one could have a more premier or preferred rental rate because of this amenity of a private patio. But that's just more meat on the bone for all of us. As we start gaining momentum, our occupancy, renovations, et cetera, we can start treating this private patio as what it should be, a major value add and potential revenue producing option for us. So let's go into what we're doing. And it totals about 1.6 million, $1 million on the outside, 600,000 on the interiors. So the first thing is if you Google gallery apartments, you're going to see a 2.7 or 2.6 overall rating, from people out there in the world. So, when we're doing these true deep value adds, branding, new name, website, there's already an incredible looking monument sign, but changing out that insert and putting in, renaming the property, rebranding it just gives it new life. It won't be day one, but it'll be shortly after. If you look at this picture, these shingles that are on the siding, it just really dates the property. We looked at pricing to change those shingles out, maybe do like hardy plank but it's just the pricing is just ridiculous. So, it's a value add property. So let's replace those shingles and put in more architectural shingles and let's do exterior painting. So that's a big part of the project is just giving it new life. When you drive by, there's 2 palm trees that completely block the monument sign. I love trees, but those trees have to go. We need to really make this place stand out as people drive by. We talked about roof recoating, the siding repairs. It's not as bad as we initially thought, but those repairs are needed, especially if we're going to be painting and recoating the roofs. HVAC replacements, we have a proposal price to replace all 101 units. Sidewalk drive repairs are going to be needed probably towards the end of our project as we're prepping to sell. Updating landscaping, amenity areas. So we talked about the amenity areas, but there's a pool that as of today is closed by the city, which again is great value add for us because of code violations. So we're going in, we're reopening the pool, we're reopening the fitness center, doing these changes. There's a gazebo that's completely like destroyed. It just over the years, it's in bad shape. So bringing back the gazebo, expanding it, putting some grill areas, putting some pool furniture, really making that an area that's inviting and part of the community. Then there's a building to the right of the pool where the fitness center will be opened. We'll have a room that's full of storage from the maintenance I've asked the maintenance team, like, is there anything in here we really need to keep? And the answer is no. So it's like, well, let's take all this out and let's make this a kids room, a movie room, a club room, additional revenue on Saturdays when people are booking their birthday parties. To the right of that, there's a storage room, which we'll keep as a storage. But on the other side, and I have some pictures of this, it's a great area for a playground. And so I'm just really excited about this area, really bringing the feel of the community on our leasing tours and the kids. I can just imagine them playing, having the pool parties, having the outdoor grill areas. There's a lot of shade, the summer heat in Houston, it all adds. But uh, so playground area, the club room, the laundry room needs renovation. New, possibly new. If we can't get out of the contract, then, or we can get out of the contract, we'll put in new laundry rooms, replace existing gym equipment. The other thing too is these of these 81 units, I have budgeted 30 units where we can do a washer and dryer. Now, there are closets already in place where we can go in and put a connection and put a washer and dryer in. I underwrote that at $20 for a rental. And in talking with Tarantino, they're saying $40 per unit for their washer and dryer, in addition to the other miscellaneous income charges. So that already doubles the line as we pursue that. But the whole idea is what we're trying to do is prep it and make it a story of, hey, we've done 81 units. We've done all these base building upgrades. We've started putting in washer and dryer units and some of these, we're building up the story. So at the end of the 3-year hold period, there's a lot of meat on the bone for the next buyer. And that's what, from a value add standpoint, it becomes not a deep value add, but it continues that value add process. So renovations on the interior include vinyl flooring, the new carpet, 2-inch blinds, paint cabinets, upgrade countertops, really just for the area and trying to make this property into a competing property in the market. We can get all this done about $5,000 per unit. And again, I budgeted $7,500 off 81 units. So this will be over a 3-year period that we do. And talking with the construction manager today, we could probably get through 5 units a month. And they're renting these units. Like we went through one rental or one vacant today. There's 2 on site that are vacant. This one had just made ready and it's already leased. And that was at that higher number I had mentioned earlier that the manager pushed it at. They spent a total of like $500 to get that unit ready. So we've got a lot to budgeted that we can do. Now we're going to test the market and sort of see what we should and can do, and not just do things just because we think it needs to be done. But ultimately, everything we decide to do, it's all about pushing rental rates and getting it to market. And again, it's not trying to push people out, but ultimately, we just want to be up to market. Tarantino, I mentioned earlier, based in Galleria, they've got about $2 billion in assets throughout the United States. They do a lot of construction management from multifamily, commercial, retail. What I wanted about them to do is manage the property, but also use the leverage and the economies of scale, et cetera, that they can bring from the construction standpoint. And by having both teams that are on the same company, same payroll, work together, then I don't have people that are saying, hey, this construction group is doing this, or we're not able to do what we need to do because the property managers, like those of us that have been in real estate, that stuff tends to happen. So the decision to work with both teams and have it be very cohesive is going to be, a very good thing. The other thing about Tarantino is they have a lot of relationships with subcontractors. We're going to get full bids. We're going to get pricing power because of the size that they have. So we're going to leverage the resources and the size of Tarantino. Some of the recognized accolades, from accredited management organization, they're just, in all my interactions with them, a very top-notch company. And again, they're based in the Galleria, so this is their backyard. Who else to manage it than people that do this day to day at a large scale that's in your market. So a few slides here about the rent comparables. So I want us to dial in on this $1.14 a square foot. That's average, between 1-bedroom, 2-bedroom apartments. So if we go to the next, $1.32, it's 1.1 mile away. But one thing I want to do is I'm not looking at Tuscany Square next door. I'm not looking at Constitution Square, across the street, maybe 0.2 miles. And you might say, why aren't you looking at your competitors like that? Well, I don't view them as my competitors. We're going to be putting in $1.6 million. And these other properties that are on these slides have done the same case study that we're doing. We're not trying to recreate or redo or be a market leader. And it's, I keep saying that. Ultimately, what we're trying to do is do what has been proven to be done in the market, and just get to market rents. So you see here $1.32. We go to the next slide. Montebello Gardens are at $1.47. This is Winsome Court, or excuse me, Montebello Gardens. Right next to this property is Winsome Court that just sold for higher than what we've bought it for. And we know the construction company that's doing that work, and they've already hit the ground. So you have owners like us that are going in and doing this to other properties. Constitution Square is on the market. I toured it last week. That may be a property we look at buying next, but this is 0.5 miles away. They're at $1.47 a square foot. I'm just trying to get to $1.35. Like, I'm not even trying, again, I'm not trying to beat the market, but total average here is $1.47. Chateau de Jean is $1.16. This is about 1.4 miles away. Park at Voss is at $1.38. Ridley, which to me is like, if I think of one case study close, 0.3 miles, 0.03 miles away, it's built older property, $1.58 a square foot, average rents. And you go there and it's nothing like spectacular. Like, they've painted, they've renovated the units like what we're doing. They've upgraded their amenity areas. I'll tell you, they charge a $50 amenity fee. They charge $35 for parking. They're fully passing through utilities. I mean, all these things that they're doing and others are doing, we're not doing, and it's like, well, why aren't we doing it? And what can we do? But ultimately it made sense because this owner didn't think like us. Like, he thought it's cash flowing, and his day-to-day primary job was being a cardiologist in Los Angeles. So it made sense. But again, all we're trying to do is just get to market. So the next property here is Yorktown Apartment Homes. It's about 2 miles away, but $1.26 a square foot. So all in all, subject average for gallery is $1.14, comp average $1.36. So that's all combined. So huge upside on the rents. And then, as I mentioned, there's a lot of upside on the rubs. And I'll go into financials shortly and talk to you on how conservative we're being on the financials, on the revenues and expenses. So the deal breakdown. So the total loan is 10.5 million. Investor equity, we're raising 4.9, so a total of $15.4 million for the equity and the loan combined. How those funds are being used is site acquisition is 12.8 million, comes out to about 126,000 a door in the Galleria, which is fantastic. Cost to build is going to be about 1.6. So this is the interior and exterior renovations we spoke about. The acquisition fees, 384,000. Loan fees and costs, 422,400. And I'm gonna dig in a little bit more about the loan fees and sort of how we're structured our loan. And then the contingency reserve is 268,952. So that's the breakdown of our funds. If we go into our pro forma, we can spend an hour going through this, so I'm gonna keep it at a very high level and just share with you where we were conservative. And so, why we feel comfortable where we are. So first, I want to start off at the top line, annual rent growth. The annual rent growth projected year one's 5%. I mean, I just showed you earlier, it's 22% in T3, but it's like, hey, the units that are not being renovated, let's assume a 5% increase. Projected year two, 4.5% increase. Projected year three, 3%. I think these numbers are too small, but at the end of the day, we have to test our underwriting and make sure that we have room in case things change in the market. But ultimately, I feel like if anyone's doing underwriting or looking at deals like this, it's a pretty conservative amount. Annual other income growth, 1%. Operating expense growth is 2%. So what we're seeing is our contracts, et cetera, going up every year 2%. But part of that is leveraging Tarantino's economies of scale, doing proper bids, getting in proper contracts, et cetera. So we talked about market rents, renovation rent increases. Ultimately here, one thing I want to point out is we're about a 10% vacancy year over year. And I feel like that's, again, another way we're being conservative when right now we only have 2 units that are vacant, and one of those have already been leased as of today. And then as we were touring around, another couple came and was looking for, leasing, the other unit. So what we're being told by Tarantino is pretty much the day that these units are on the market, you were getting activity, and by day 3 or 4, they're leased. Okay. So very, very conservative on having a 10% vacancy. Now on the RUBS piece, and the RUBS stands for reimbursed utilities reimbursements. And so the $750 per unit. So right now the property is about 67,000 and reimbursed. I have this going up over 3 years from 75,000 to 137,000. This 137,000 is 82%. If I go to my next slide, of utilities. Okay, so my overall utilities is going to be about 168,000 projected year 3. So if I take that and I just do 82% reimbursed, I'm going to get to this this income number on the RUBS. I should be doing that in year 1, and that's the expectation to do that year 1. Every other property does a pro rata share, but I want to again be conservative over a 3-year period. We are pushing rents. We are doing a lot of renovations. So I also want to, not go too crazy. But at the end of the day, if we're able to push parking rents, if we're able to push RUBS just because we're in the market and that's what the other competing properties are doing, then we should do it. Now, one thing I had learned today actually is if we will do this, is sub-meter the pool and the irrigation, and then we can reimburse up to 95% of utility. So remember, I only did 82% here. We can push it up to 95%, assuming we're 95% or higher occupied. So a lot of upside still on the RUBS. On the other income, we've got 62,000 T12 here, and we're pushing up to 112,000. That 112,000 is parking. Getting it up from $20 a parking space to $35 a parking space. It's being, pushing on pest control, pet rents, application fees. Really, and I mentioned about the amenity fee that the Ridley's doing, $50 an amenity fee. But if we have the clubhouse and we have a nice fitness center and we have a nice pool, we look at getting an Amazon hub, things that we're going to be. All right, sorry about that. Go ahead and put in the Q&A if y'all can hear me. Testing 1, 2, 3. Okay. All right, perfect. Thank you, guys. All right, so keep going on. So on the other income, we had mentioned parking revenues. We had mentioned the pest control. We mentioned the admin, other fees. So we're just looking at what other properties in the area are doing and pushing it onto, to our property. So we feel very comfortable in going in again with our management company through the RUBS, through the other income. If I'm going into the property management fee, it's 3.5%. General and admin is 150. Contract service 125. Marketing $100 a unit, so about 10,000 a year. Payroll is about 1,350. Repairs and maintenance, so it's 1,350 per unit, so about 136,000. So you'll see a lot of these numbers were growing year 1 projected from what's been operated at. Repairs and maintenance, typically I do about 400 a unit. We did 300 because we're replacing the HVACs. We're doing renovations to the roof recoating. Turnover costs, I got $100 a unit. Insurance, the fantastic thing about insurance is we are taking the policy that's currently in place and transferring it over. And we've looked at other sources, but the group that we work with felt like this was a pretty solid way to do it. And the reason is because at a per building loss, they've got a $10 million policy, which is incredible. Insurance groups are not writing those type policies anymore. So we're taking that and we're transferring it to us. So we've got about $700 a unit for that. Real estate taxes, I use Morrison and Head to give us projections for sort of like a worst case and a best case scenario, and we use the average amount. And so we did that here. Utilities growing from, you'll see utility increases year over year. Now, I don't hopefully expect that. We'll find ways to reduce consumption. But again, from a conservative standpoint, we want to be that way, put those in. So our net operating income is $554,000 year one, $739,000 year two. So year one is not a cash flowing property. Once we get into debt service, it doesn't cash flow. And I tell you that because it's a true deep value add, and it typically won't. These type of deals do not cash flow year one. But what we do see is that years two, it starts cash flow. And in year three, when we sell, there's huge forced equity appreciation. So this is a major equity play that we're planning on doing. But I also want to make sure that we're all on the same page as far as what we're looking at from cash flow. So how the deal structure is being set up, it's a 70-30 LP to GP split. It's a 7% preferred returns. So before the GP sees any returns, the 7% is prioritized towards our investors. There's no preferred class or equity group coming in. This is all Class A shares. We're doing it after 18% IRR. So once the property is sold, we'll split anything over an 18% at a 50-50. So at a limited partner level of return, investor IRR is at 17.2%, equity multiple of 1.62, preferred return at 7%, and an average analyzed return of 20.7%. And I really want to highlight that this is a 3-year deal. So typically on a 5-7-year deal, you're looking at a 1.8x, maybe up to 2, depending on what's going on. But over a 3-year, we're at a 1.6. The other thing that I want to point out is we're working through the loan piece, continuing to modify that, is we had a $4.9 million equity raise, and that's our plan on raising that capital. If it were to come in a little less because we're able to push our loan to costs through the leverage of the loan, these numbers skyrocket. Over investor IRR over 20%, equity multiple over 1.9. So these are conservative numbers, and even based on the projections of rents and the expenses that we talked about previously. I always like to do the sensitivity analysis. If I go back, and I'm not going to do it, but if I go back to the slide, if you remember, I did a 5% year one, 4.5% year two, and then 3% year three and on. So I did a staircase, but if I just did, 3% rent growth at a 4.25, overall IRR 13.49, rent growth at 4%, 16.6, 5% rent growth, we're at 19.62, mentioned 17.2 previously. So the IRR grows when we have stable year over year rent growth. 6%, if I was at a 4.25 cap rate, I'd be at about 22.56% IRR. The market cap rate right now is a 3.5. Okay. So at 3.5, we typically do 10 basis points per year. With the rise of interest rates and things in the market, we're feeling very comfortable pushing up to 4.25 on our exit cap. And again, with the staircase of rental rates, we're really excited about a 17% IRR for a 3-year hold. But if we were at a 4.15 or 4.05, I mean, at a 4% year over year rental increase and our cap rates at a 4.05, we're pushing about 19.79% our IRR. So, take this as it is, but I just really want to show the overall exit cap and the rent growth, and sort of just where the numbers could end up being when we sell in 3 years. So let's talk through the gallery investment timeline. So we signed the contract on April 1st. We had our due diligence last week, and we walked every single unit during our due diligence. We had electricians, we had plumbers run camera lines, we had the roofer on site, we had the HVAC, a lot of expense in time has already gone through due diligence. This coming Thursday, we already have a property condition assessment being ordered that the lender will require, but a lot of due diligence. We know what we're getting into. Not of it all is good, but we're well capitalized to get through it and make sure that we're making it better for one, the residents, but two, the next buyer. So we're setting it up for an incredible opportunity just a few years from now. The investor webinar was set up today, April 19th. The PPM availability is scheduled. Our attorneys are saying we should have it this week, but I'll put out here April 25th. We do use Syndication Pro for our portal. So everybody here and those listening, all of our documents and everything will be done through that portal where, everything's in one place. And those that have been on previous deals with us know that we do monthly updates. We just issued K1s. Everything is in that portal. So you have one place to go see all your information. So that PPM will be there for y'all to review and sign, and then also information on where to wire the investment as well. Which brings me to April 27th to the May 11th is investors funding. I fully expect we will likely be fully committed this week or next. We have other partners. I mentioned Rob and Jeffrey and Jennifer. They are raising capital as well, and we're getting a lot of great feedback and excitement from it. So I will say those that are on this call, y'all are first in line, first up. So I'll provide a soft commit QR code shortly, but we have a pretty tight timeline on our funding on April 27th through May 11th. The reason is because our closing's on June 1st. And it may be June 1st to June 15th. It depends on how fast the appraiser can get out and the lender can finalize loan docs. And then anticipated sale is 2025 to 2027. So here's the thing. We're using bridge debt. And if anyone's listened to my podcast and gone to my meetups, I am a big proponent of bridge debt, but I'm also very scared of bridge debt. And I'm scared of bridge debt when you don't have properties that you're buying that have true deep value add. People are buying properties at a high price with bridge debt because they don't meet the requirements by agency debt. What really calms me down and gets me excited about this is that this is a true deep value add where bridge debt really makes sense and why bridge debt is needed, because it wouldn't qualify for an agency, right? So we're doing a 3-year bridge debt. We are using Deco Capital out of Los Angeles to source our debt. We should get multiple bids in or multiple lender quotes in this week where we'll select and go. But what will be is a 3-year bridge, and then we'll have 2 1-year extensions. Okay. So we could hold it up to 5 years before refinancing or getting into another loan. But again, we're going to push for a sell year 3, but we have room. The other thing we're doing is in the source of funds, there is a loan cost. We have already included a cap rate dollar amount for paying. Our numbers work at about a 7.25% interest. We underwrote it at 5.25, and then over the next 3 years, over the next 2 years, we had it growing to 7.25% interest, which seems crazy. But we stress tested our model to that point, and we're capping a rate. We'll be paying, part of our funds is to pay that cap rate. So it's something that, whether it's this deal, other deals, definitely something to look into. But we feel very confident and comfortable with our lending structure. So I put in here anticipated sale date of 2025 to 2027. The goal is to sell 2025 or earlier. This is an equity play, forced appreciation, true deep value add. Really super excited to get this project underway. Now, this is a 506B offering. I typically do 506C offerings, but I really wanted to give everybody an opportunity who is not an accredited investor, who has a relationship with us as a sponsor team, to be part of the deal and be part of multifamily investing. So for those that are accredited and we don't have the relationship, but you're an accredited investor, you'll have to supply or produce a CPA in good standing, saying that you meet those requirements that are defined by the SEC for an accredited investor. You can do that through your attorney as well. What I typically do and I recommend is verifyinvestor.com. It's been very quick for our investors. It's a pretty painless process, and we get a form documented, and we're able to do that. For those that have a pre-existing relationship, there's some paperwork that you'll fill out with the PPM. There'll be the subscription agreement and the operating agreement, but in there you'll disclose how our relationship is and came to be. So more to come on that, but super exciting for those that haven't been able to invest in deals because you're not accredited. This is one to for sure look at and get on board with. So with that, everybody pull out your phone and do your QR code or your camera, take a picture. It should take you to a website where you can go ahead and soft commit. You're not wiring any money today. There's no paperwork to sign. All this is to see where we are, one, from a capital raise standpoint, but also two, to continue setting up conversations with you to see, what the next steps are, provide you the PPM that's where the securities is really transacted at once you have all the information with the PPM, and then we'll continue moving forward. So I have a few questions that I'm gonna go through. If you have any questions, go ahead and go through the Q&A. We've got about 10 minutes that we can do. It's pushing past the 8:00 hour Central Time. But if any questions are not answered on this recording of this call, we will be happy to meet offline and dig in on it as well. So with that said, let me look through the Q&A here. One question here is how are the schools? So if I recall, Pilgrim Academy is an elementary school. When I looked on greatschools.org, it was about a 6 out of a 10. Tanglewood Middle is where this property is going through. It's about a 7 out of 10. And then Lee High School was 2 out of 10. I don't know what's going on with Lee High School, but ultimately it is a good school district. There are a lot of families in the area. I mentioned earlier that Galleria has a lot of high earning professionals that live in the area. So there's a lot of private schools as well. One of the questions here is what is the median income? Within the median income within CoStar of 1 mile, about 47,000 annually within the 1 mile of Gallery. And which is huge because we typically do rents, when we're looking at potential applicants, we want to see that their monthly income's at least 3 times their rents. So going back to earlier rents, we're set up pretty well from an income standpoint. One question here is how confident are you with construction numbers? I'm very confident. We had people that came out last week. And then I met with team members again today, early this morning. And we're going to be getting a full report from Tarantino later this week. But in talking with these subcontractors, and I'm telling you, we had the foundation people, the plumbing, electrical contractor, the roofer, and others, and getting in pricing of what we're doing. And what's huge about that is like this isn't a 6 month, we're getting things ready and we going out to bid and all that. It's like, no, we already have the scope and we already have, the people who we were wanting to bid to. So let's bid quickly, make sure we have solid scopes, make sure we have good contracts in place, and let's go. This is going to be a pretty quick process. All right, let me go through some more here. Yeah, one of the questions is the PMB incentivized to help get rent to market, and what's the percentage for PM? So their percentage is a 3.5% property management fee. The property management company as a whole is not being incentivized. However, the property manager is. So I want to make her and the team money for hitting our goals. And with any property management company out there, you're only as good as the boots on the ground, right? And so, yeah, we have all these layers of supervision and processes and procedures, but really want to incentivize day-to-day property manager and the maintenance team. So in our numbers, we have, per lease. Mentioned earlier, flooding. There has not been flooding at this property from a named storm or any storm that I'm aware of. One of the things that we need to do, and we will do, and I have money allocated for that, is to go out and clean the drainage, all the drainage pipes. Like, we're just going to have the plumber come and flush and clean everything out. So when we do have those heavy storms, we have all the drains and the systems in place, but I don't feel comfortable that they've been maintained, honestly. So what we're going to do is not really care about what's been done in the past, but go in and clean up and make sure that those are draining the way they should. Yeah, one thing about Houston, if you've been in Houston, I mean, one side of the neighborhood can be, there's no zoning, there's, it's, income and everything can fluctuate. I could tell you comfortably, this property is in a median income of 46,000. And it's the further, just between Westheimer and Richmond, that was according to CoStar, but just seeing the massive changes since the 19 months of me looking at it, things are changing quite rapidly in all the renovations that the city is doing. So we're feeling really good there. Yeah, good question here on the bridge rate. So what we're being told is that to budget about a 4% plus SOFR. We're thinking that we should be able to get closer to 3.5% plus SOFR rate. But what we underwrote was 5.25. And then what we did was do a SOFR on top of that. And we look at the Shatham financial model, because I'm one of those guys. And Rob, our partner on this deal, is very analytical and financially driven, right? And which is good. You got to be when you're investing in these type of deals. But we wanted to look at a reputable market source. So we looked at Shatham Financial and look at where they saw SOFR rates going over the next 3 years. And what the market and what the quote unquote experts are sharing is that over the next 2 years, we do expect rates to continue to increase. But over the second and third year, rates will start coming down. So our financial model, as I mentioned, is 5.25%. And then we just followed the Shatham model throughout the entire 3-year process, not taking into account that we're going to have a cap rate that we're buying. So again, for us, it was comfort that we were comfortable that, we're going to be, we'll be in good shape. We don't see our rate exceeding 7.25. So we'll buy maybe, a 2% cap over a 2-year period. And then that third year, we'll buy another cap. So this is a 3-year IO. It's bridge debt. So all the majority of the renovations and the cost to purchase the property is included in the loan. We are coming in with 30% of the equity, and we may not need to. It may only need to be 25%. This is why I'm telling the team here to, go ahead and do your soft commits, because it's going to go pretty quick, especially if we're doing a 25% leverage. Let's say we stick to 30%, we do a full 4.9 million raise. We'll see the 3-year IO, but we'll also be drawing down, when they do a 1.6, it's sitting into like an escrow account, and we will, using the working capital, we'll start the work immediately. And then as we pay and as we provide invoices to the lender, then they start paying out. And so our loan will increase over time based on the progress we've made on projects and how much we're taking out of the renovation capital, right? And so our model is showing, month after month of our loan increasing because we're taking on more of that draw from the construction piece. I definitely will send a replay of the webinar. On the DSCR, I will have to check. I want to say it's 0.75 year one, but I'll have to double check. It's not good. But that's okay. Like this is this is a deal that's a true deep value add, and with all the supporting case study properties in the area, um, this is what gets us excited about it. It's like, we're going in and we're not trying to be market or over market. We're trying to just get to market. What I think is more important is not so much the first year DSCR, but where we're sitting at year 3. Year 3, we're close to 1.25. And I like that for several reasons. And I don't plan on doing this, but this is something that, I'm always looking at multiple exit strategies. So in year 3, the goal is to sell. Heck, if we can sell in year 2 and get massive returns, we'll look at that as well, obviously. But year 3, say we go as planned, and we sell, then we'll have those IRRs or those equity multiples that we spoke about earlier. But what if the market isn't doing, maybe it's not a good time to sell in the market. And so we have the option of extending our bridge debt 2 years, to get through market conditions. But something we've, should consider is also potentially refinancing. Again, that's not the play or not the strategy for this, but the thing that we have to do as active investors is, one, ensure that we're prioritizing our passive limited partner capital first and foremost. So it may make sense to do a refinance. And at that point, that's where the DSCR matters, really, because we have options. We have options to go 1 or 2 years with bridge, or we have options to refinance, pull capital, which is not taxable. So a huge benefit to our investors, and then continue cash flow until we sell. So unit rehab. So we have $7,500 budgeted for the unit rehab, and going through the budget today, I think it's going to be closer to $5,000. What it includes is that vinyl flooring, upgraded countertops. What I'm being told is it's granite countertops are reasonably priced right now. We're not going in and knocking out the cabinet boxes, but looking to either replace or resurface the doors. Put some new hardware fixtures. The appliances are already newer in the last few years. That's one thing that they have been doing, is replacing. Like today, I went into a unit, the refrigerator and the microwave were black appliances. The washer, the dishwasher was an old, so we'll have those one-offs. Where it makes sense, where we can do the 2-inch blind, it looks a lot better than the curtain style blind that they'll have. And there's some windows that we can't get away with it, but where we can do the 2-inch, we'll do it. New lighting package is also just to brighten up these units. Part of that rehab too, as I mentioned, is the HVAC replacements, which is going to be huge, and resurfacing the roof. But we're getting it to the market around town, and so as we get through and we continue to look at costs and comps and sort of supply chain and all, we're going to come up with that standard that we're just going to rinse and repeat throughout. I had a question here. What was the vacancy a year ago? What percentage of the vacancy is loss of market rent? So I will get back to you. I do know it's probably pushing over 10%. I think it's about 12% economic vacancy. And a big part of that is due to COVID. They have, there's 8 units right now that are going through an eviction process. And big part of that was there were duplicate payments made to these renters. And, it sort of, is what it is with these, with multifamily apartments in general right now. I mean, we're getting through COVID and such. The positive news on that is that as soon as those renters are out, they have been making them ready to lease. The other thing too that I love about Houston and I love about Texas is we're a very landlord friendly state, and so we were open for business and working and ready to go, and we, when other states were not. There are a lot of judges and politicians, et cetera, that are, of the mindset that, you got to pay rent. So I feel like that We'll continue to get better, but again, we kept it at a 10% vacancy year over year. And I can tell you now there's 2 units vacant. All right. Any other questions out there before we end? No, I am going to send the recording out, and I will follow up with everybody. But if you could, again, use your phone, use the QR code, put in. I mean, y'all are the first ones to see this presentation, and we'll have the so that first come, first serve type thing. Cost segregation is in process. I am expecting, we have pushed out to Madison Specs for them to look at our cost seg. So more to follow on that, but we expect, because of the value add and age, et cetera, we should see quite a bit of cost seg depreciation on this. So we're definitely looking at that. So, well, thank you, everybody. I appreciate everybody's time. We spent a little over an hour or so talking about this, but expect we can definitely continue talking about this property over the next week or two. And for those investors that are investing in it much longer, so y'all can be owners with us with Gallery Apartments. So thank you, everybody, and hope everyone has a wonderful evening.